I'll bring Sean on now. Let's see if we can unmute him here. Sean, good morning.
There it is, unmuted. How you doing? Good morning, guys.
Doing good. How about yourself?
I'm doing well. Long weekend,
Yeah,
so
hope you're able to get outside, but stay away from the crowds. I know that's sort of a contradiction, but
definitely, yeah, it's been a different time period for sure.
so Sean, I was out driving this weekend. I went on a mini road trip, and I was on a toll road, and I saw in Ohio and signs all over the place saying, due to COVID, we would strongly prefer you not pay your tolls in cash. We would really prefer if you paid your tolls in credit cards. And it got me thinking about the something that we've talked about in the past, the shift away from cash on how that could benefit companies that you like Square, for example, and how this could accelerate the shift away from cash into more of a cashless society. Talk about that. Have you been observing this as well? And I would imagine as a Square bull, you would encourage that.
Yeah, no, definitely. I think we are seeing that shift, and just think about the direction of society. It's quicker. It's cleaner for companies to manage their own finances, right? Because now you have oversight of where money's going, who it's going to, the speed of it. So there's a lot of characteristics there that are important to the businesses. But more importantly, as it relates to some of the players that are facilitating it, it's monetizable when it goes to electronic. So when you walk down the street or you're driving down the street, just like you said, and now you're processing those payments electronically, again, they're monetizable. And Square put out some numbers recently about some of their companies and broke those down into industries and categories, and just the uplift from companies going from mostly cash to now mostly electronic. Now, if you think deep down about those companies that were only processing their payments through cash transactions, and these are Square sellers, are going from 5% non-cash to about 75% non-cash. You could actually lose. I mean, in theory, when you start to balance out those market weights for them individually, if they do lose 30% of their sellers, given the environment, but their sellers go from 20% non-cash payments to 75%, you can make it up in that with that uplift as well. So you are seeing this massive shift take place, and I think it's here to stay. So it's important for everybody.
Sean, if I wanted to trade or participate in the shift away from cash, so Square is one way, but how else could I do that?
Yeah, the two most dominant networks are in a sense PayPal and Square. You can go underneath one layer deep, which is Visa and MasterCard, obviously, which are touching more and more of not only what you see with Square and PayPal, where you have Venmo and Cash App and some of the more consumer-oriented or consumer-facing products, but at the infrastructure layer, it's Visa and MasterCard that really gets you exposure to everything digital. And the moat that they've built over the years, I mean, you see it in their margins. It's incredible, the margin profile that they've built out, and seemingly have no competitors as everyone else is building on top of them. So Apple Pay's tried, PayPal tried to create their own internal network, and they ended up having to partner with all the vendors on the side. So those are the two dominant ones because they have built out the more dominant network effects. There's companies on the side, on the fringes that are participating, and you're seeing more and more companies participate in financial services to begin with. We saw Uber try to launch their Uber Pay product and then take it back because, again, it's hard to build those networks out. And we saw this morning they have to focus on their core business instead of trying to reach out into different pockets. So those would be the two dominant ones that I'd say, and then the other two on the infrastructure side.
We're on the line with Sean Emory.
Real quick, Joe, can I interrupt real fast? I just want to follow up with a question from the chat.
Yeah.
Would you just use the ETF? Would you buy the IPAY ETF just to play it
I
out?
don't know the exact makeup of iPay. We don't really touch that. We prefer to know exactly what we're owning, why we're owning it. That's just our style mantra. But at the same time, I'm assuming those are probably for the dominant positions in that category. Obviously, over the last year, Square is making some more noise relative to those. Those are kind of the blue chips. And I think at some point we'll be looking at Square as a blue chip. So
now we're on the line with Sean Avory, founder and CIO of Avory and Company. Sean, thanks for joining us after the holiday weekend. You got an interesting stock on your radar here, and coming out of the COVID-19 crisis, let's talk about Planet Fitness here. And that's something on your radar, and if you're looking at it on the cheap here. It's come back a little bit. Talk to us about it, how long you've been looking at it, fundamentally, technically, and what are you hearing from the company?
Yeah, it's been quite a bit of time that we've been looking at it. So Planet Fitness fits in that category right now of the things you kind of don't want to touch, right? Brick and mortar, from a hygiene standpoint, doesn't make a lot of sense from just if you're separating the winners and losers of COVID-19. But Planet Fitness, when you look at it, it's a very asset-light model. They franchise pretty much 95% of their locations. And these franchisees aren't your 1 unit, 2 unit franchisees. These are pretty large franchisees. I think they have 133 franchisees covering those 2,000 locations that they have spread out. I mean, their really dominant position is that it's the low cost provider. And as we've seen in cases like Walmart and some others, Amazon have essentially created their business was come in with scale, be the low cost provider, provide some sort of network effects in the middle of that. And you're seeing that take place with Planet Fitness today. Those franchisees, a lot of them are private equity groups. So you have very sophisticated management teams that also have dry powder in an environment like this should 1 or 2 of their locations not necessarily survive. And then speaking of kind of survival in this environment, one of our areas of focus is looking for categories where there was a structural trend already taking place. And obviously with COVID-19, you were somewhat unlucky to be a fitness center. But this is a highly profitable business, and a lot of their competitors, specifically more upmarket, your $20, $30, $40, $50 a club, a lot of those chains now have filed or are filing for bankruptcy. So you have a competitive environment for them that is subsiding. The 24-hour fitness right by me is no longer there. So you have a lot of open space for them to continue to scale out their units. They have about 1,000 units in the pipeline today that are already committed to. So that takes you to 3,000. The unit economics for a franchisee are really, really attractive, which is why you see very sophisticated teams come in here and try to wrap up 10, 12, 15 units at one time. So it's a really interesting environment for them when we get to the other side of this, that they become much stronger, just given that they have this network effect taking place. And again, we're in communication with them constantly, trying to determine what are the different characteristics taking place. And that at a high level, I think our overall thesis on Planet Fitness. There's way more there, and it's actually much more interesting, specifically how they've, during this environment, embraced technology. And I don't think that was even a 12-month, 18-month strategy for them, but it accelerated pretty drastically here. And I think that's going to potentially lead to pricing power for them in the future and net churn.
Hey, Sean. I just got a question. Just on Planet Fitness and so many other stocks. I mean, you're a fundamental guy, and you're sitting there and obviously, crunching numbers and looking at, the overall story and looking at the technologies and looking at these companies from a fundamental perspective. How do you, on a stock like Planet Fitness, though, separate it? Like, if you're looking at it today, you can say, okay, we're going to get past this virus, but how do you value the issue of COVID when it relates to Planet Fitness, and how do you look at all, even when you look at Square? I mean, there's a lot of retailers that are closed or, not doing as much business. How do you find a way to fundamentally crunch the numbers with COVID out there?
Yeah, I mean, to be completely frank, we're never looking a quarter out or even 2 quarters out. So if this is truly a 3-quarter event, that's not even in our numbers, right? So
you're looking past the virus.
Yeah, we're looking at how many units can Planet Fitness, for example, get into the U.S. and then beyond that. They're scaling out internationally as well. is that 4,000 boxes like they say, or is it really 5,000? Is it 3,500? We already know the economics of each box. So it's fairly simple math once you get there. And then you're trying to adjust for pricing power. Are they going to add a third membership tier? Is it higher? Is it going to be lower? If they do succeed on this technology front and they're offering these free classes with iFit, and then they potentially monetize those, what could that do to pricing power? They have the black card versus white card, and 65% of their users are using the black card, which is the higher tiered fee or higher membership. Can they move that into 80%, 90% as they continue to add more services? So that's kind of how we're breaking it out. And then we're asking ourselves, what would we pay for one box? And now they have 3,000, and that's going to give you kind of the value that you think this company is worth. And that's how you would look at like a Planet Fitness. Square, for example, has always been long-term, right? I mean, this has been a story in which we didn't think Cash App would be as accelerated to where it was today. And the more interesting part about kind of Square in this environment, even companies in general that are, you could say, benefiting here, you got to ask yourself, are they benefiting because of things they did, or are they just benefiting because COVID? Outside, right, we know their seller business, but the Cash App business is on fire. I think they've added almost 15 million, 16 million users over the last 3-4 months that have gone on the platform. And much of that is to their own credit, where they were offering direct deposits for your stimulus check into your Cash App. So they had a huge influx 2 months ago of new users. And then stock trading. So we've seen what happened with Robinhood and the amount of interest and demand that they've seen. You're seeing that same traction in Cash App, given that they happen to launch stock trading just before this. So again, you're seeing this progression and also the management team's ability to execute given this environment. And that's super important to us. So again, it's much more structural long-term, and thinking about how much share can they get in their seller business? How much share can they take in that Cash App business? And then you're asking yourself, are these two ecosystems at some point going to interconnect in a much more meaningful way? Or is this going to be the eBay, PayPal separation where there's some synergies there, but maybe there's not that much synergy there long term, and actually separated, these are two much more valuable businesses. Again, like we saw eBay, PayPal. And yeah, that's how we look at these. And the quarter to quarter is just credibility towards the thesis more so than we don't care if they beat or miss on a specific report. Honestly, it's fairly meaningless. It's more directionally, where are we headed here?
Sean, going back to fitness for just a second here, what did you think of the Lululemon Mirror acquisition?
Yeah, no, it's interesting. This is the first time we would ever see potentially an apparel retailer succeed if they did succeed here.
Yeah, right.
I did go out and look at all the different competitors, and I think they bought the more streamlined product that's out there. We start to look at all the other offerings. They have like weight sets inside of them, and a little less, I guess, flexible, right? So this is just a flat screen, basically a TV on a wall, and interesting offering. Obviously, the timing of it for Mirror, it couldn't have been any better. And it's going to be hard to see because Lulu is not a technology company. They are not this isn't their space. We'll see what they do in terms of management, who's leading what, who's going to be directing initiatives. It's interesting. I think at some point for like a Lululemon single brand, talks to fitness, talks to kind of yoga. And I think it's important directionally for them. If they can execute on it, obviously it would be huge. I don't know where, again, that synergy comes and truly takes form. But it's an interesting idea. I can also see that product being ripped off by almost any party out there and provided to the market for much cheaper. Apple, everyone's talked about the Apple TV. They wouldn't do it, but they could do it. And I think the fact that they could do it and don't do it probably tells us everything we need to think about how they view that product.
That's always the elephant in the room. Well, could Apple, Amazon, Microsoft, Facebook, they could do it. They might not, but they could, and that'd be better.
Right.
Here's one that we've talked about as being a COVID play. It's on your radar as well. Fiverr. It would make sense, obviously, that a business that matches freelancers with people seeking freelancers would be good in a time of high unemployment. But why is this on your radar?
Yeah, no, Fiverr's been something we've been following for quite some time. We didn't actually early on in the story. So they have very much the feel of of Wix in terms of their management team, who's on the board. I mean, there's ex Wix all over the place. They're in Israel, just like Wix. They speak the same language in terms of TROI, which is the way they talk about how their investments spend. So at the initial onset, it just screamed Wix in terms of how they were running this company. And years ago, we've even talked on this show, like many years ago now, about Wix. And Fiverr, for example, when you think of just their value add to the freelance community, one is the freelance community is growing. We did a lot of work around what percent of the working population could move to more freelance work. And this isn't like your traditional freelancer, right? It's somebody that has a skill set that's just simply offering that and right. We're really just decomposing a job function. And that's what ultimately freelancing is. And it's whether you can do that in mass scale. So you start to look out at the marketplace and you say, okay, here's Fiverr, here's Upwork, here's freelance.com, here's some of the other players. And what Fiverr did was, instead of charging per hour, per unit, they really tried to productize the actual job, right? So you're going to buy a recording for $25, right? So it's more of a true e-commerce feel of shopping, as opposed to trying to bid and communicate and try to negotiate the offering. So Fiverr decided, let's make it as easy as possible. And ultimately what they're doing is removing friction between the buyer and seller within freelancing. And I think that goes a little bit under noted over the last several years as they've done that and continued to take share. They're doing a lot of things internally, like they're doing an ad product now, similar to what Etsy did about a year and a half ago, or started a year and a half ago and has launched here in the last like 6 months. They've also have Fiverr Studios, which is a combination of freelancers on the site getting together to offer one project. So that's really, really interesting. Fiverr Learn, Co, which is like an off-site product. The most important thing for us with Fiverr, though, is when we started to look at what they were doing, we've always asked ourselves, freelancing offline is also a big thing. And I'd say 3 months ago, we noticed, because we're always on the site trying to see if there's anything new out there, obviously outside of things they're telling us, and they had a little beta section that said photography in New York City, I think it was, for offline freelancing, right? So someone can do your mock-ups on site digitally, but they're also trying to take that offline. And I think that obviously doubles that market size potential if they can successfully navigate offline and online freelancing. And I think that would obviously remove churn of any of their freelancers. So they have 2.5 million users on that platform. It is truly a two-sided marketplace. And in this environment in COVID, for example, what excites us is their category expansion is incredible. I mean, if people are doing more podcasts, they just add a little tab of podcasts, and then all the freelancers go straight to that tab. So they're able to flex their categories left and right, but at the same time, go deep into one. So they run their team in category specific units in terms of product managers and such. So it's an excellent team. Their market expansion is is deep and wide as they want to go. And that's what we like about it. Instead of being a vertical focused kind of product platform, it is truly horizontal. So
one more, Sean, this is from our chat, going back to the payments discussion. This is a stock or a company I don't know a lot about, but we were asked to ask you about Shift4 Payments, ticker is FOUR. Do you know anything about them? Are they on your radar?
They're not on our radar. I mean, we've heard of them, obviously. They don't compete directly with any of kind of the companies that we're invested in. And I mean, compete in any sort of scale. There's a lot of competitors, but there's very few that actually can compete with a seller base of 2 million and such. So.
All right. Sean Emory has been on with us. He is the founder and CIO of Avory and Company. That's AVORY. You can find more, learn more about them by going to avory.xyz. Sean, thank you so much for the time today, and stay safe down there. I know it's getting a little bit hairy down where you are.
Yeah. Definitely it is. I'm keeping up with the stats, and I don't like it.
Yeah, us neither. So stay safe down in Florida.
Cool. All right, guys.
All right.
Thanks, Sean.
Appreciate it.
All right. 8:54 here. About 5 minutes left in today's show.